While Wall Street celebrates the Fed firing up its crisis-era money printer again, what if I told you it's really a desperate bid to mask a liquidity crisis they can't fix? Because the Fed has slashed rates, they ended quantitative tightening, and yet nothing has stemmed the liquidity drain. In fact, reserves have plunged to $2.83 trillion, and that's from a $4.27 trillion peak. And what this is doing is risking a 2019 repo freeze that could lock up credit markets and send stocks crashing overnight. Because when liquidity vanishes, it's not just banks that suffer. It's your job, your income, and your wealth. They could all evaporate in a flash. But this fix carries a hidden price. We're talking spiking daily costs. That means inflation going to go higher. And crumbling yields on savings, that's going to impact millions of savers. And if it flops, that's my base case, what it signals is we're barreling toward the next big crisis faster than most Americans think. Now stay tuned, because I'm going to reveal exactly what you need to do to profit from this mess, and more importantly, how to shield your portfolio before the dam breaks. Now on Friday, our CTA Timer Pro subscribers cashed in big on that silver trade, locking in an 11.69% return in just under a week. And the other day, we dropped even more trades and they're taking off. Now, if you're ready to make gains like that, no matter which direction the market goes, grab those links in the description below. Use a coupon code for your free 30-day trial. And stay tuned to the end of the show for more information. Now let's unpack the Fed's announcements. Because they slashed rates by a quarter point, they're now down to 3.5% to 3.75%. And this is the third cut this year. The Fed cited moderate economic growth, but they noted slowing job gains and the unemployment rate ticking up to 4.4% as risks. But the real risk, inflation, it's sitting at 2.8%, and that's well above their 2% target. And while the Fed claims they've got eyes both on the employment risk and sticky prices, the reality is inflation is likely to go higher. Now, we just heard this from small businesses said they're looking to raise their prices. And we know at the factory level, the input prices still continue to rise, and they're getting squeezed at the margin to the point they have been saying they're going to pass it on to the consumer. But what was the real headline grabber? It wasn't the rate cuts, not inflation. They're reviving a Bernanke-era tool, the money printer. It's back. But that now is going to be rebranded as reserve management purchases. And starting on December 12th, the Fed's going to be buying about $40 billion a month. They're going to be looking to purchase T-bills all the way up to 3-year Treasury notes. On top of that, they're going to reinvest all maturing proceeds across the curve. Now, what is the goal here? Well, it's to boost reserves back up to that critical $3 trillion mark in the hopes to avoid another liquidity crunch. Now, the Fed says this is market neutral, but think back to QE, what it was intended to do: drive up asset prices and inflation. This time, it's completely benign. But let's call this what it is. It's a technical band-aid on a gushing wound in the financial system. So let's dive in deeper. I want to expose a hidden crisis here, then I'm going to arm you with the trades to profit when this whole thing blows up. Now let's look at why this neutral move screams liquidity panic. Because how often does the Fed cut rates and bring back QE at the same time? Only when things are bad. Now let's talk about their own projections here, because they're painting a rosier picture than reality. Growth upgraded to 2.3% for 2026. Inflation, can you get this? Cooling off to 2.4%. But the dot plot? Look at this. The median funds rate at 3.4% by the end of 2026, implying one more rate cut next year. But if the labor market goes, you know there's going to be a whole lot more than that. But this is very simple. It's all messaging to the markets. This is simply a preemptive cut to deal with liquidity issues. There's nothing else to see here. Now, the hawkish undertones, what they're doing is they're tying directly into this reverse management purchase binge. Because again, we're talking $40 billion in initial purchases. With reinvest, we're talking potentially $60 billion a month. It's no coincidence this is all happening, because again, reserves have dropped to $2.83 trillion. And what we're facing here is, again, a repo meltdown like 2019. But according to the Fed, this is not stimulus. What we're facing is survival mode to prop up the banks and keep them lending. The reality of the situation here is this reserve thing, it's all a sham. We don't know how many reserves need to be in the system, because going back to 2008, we had no reserves. The real issue is what they're not telling us. And that shows up here in this chart of commercial industrial loans, because what you're seeing here is commercial lending is already contracted at 3% from this time last year. What it's telling you is money is being drained from the system. And unless banks start lending and you see that blue line turn above the horizontal black line, the situation is going to continue to get worse. But it's not just the banks, because when you look at the labor market, it's also cooling fast, and what it's doing is amplifying the liquidity squeeze. Check this out. Employment costs are now just at 3.5% annually. This is the slowest pace since mid-2021. And quits, they're at 2020 lows. And layoffs, well, they're continuing to rise. So why aren't people quitting? It's simple. They look out in the labor market, they see their friends on the unemployment line, and they realize there's no opportunity. You've got to stay put. But let's tie this back to what happened in the Fed meeting. Goolsbee and Schmidt, they dissented. And why did they do it? Because they cited that there was issues with inflation from wage pressures. But what I want you to understand, we're not going to see wage pressures here, because when the unemployment rate is sitting at 4.4% and likely to go higher, you don't get wage growth and you don't get inflation. And this next chart proves it. Let's take a look at the employment cost index in blue against the unemployment rate in red. And you can see as more workers hit the unemployment line, wage growth is going to continue to slow. It's simple to understand. If there's available workers on the unemployment line, employers don't have to give out raises. Meaning, again, what we're facing here is no fear of demand-led inflation, and yet two members think that's what we're going to see. But the reality of the situation is the liquidity problem isn't going to go away because we get rate cuts, because where wages go, bank lending follows. Let's take a look at this chart of commercial industrial lending, still shown in blue, now overlaid against average hourly earnings of production and non-supervisory employees in red. And you can clearly see where hours work go, demand for lending follows, and this contraction, it's not likely to change no matter what the Fed does. So it's not just the labor market that's going to see less income. Billions of retirees and savers, they're about to get hit what's going to be called the great income squeeze as yields now start to plummet. Because up until now, investors were paid handsomely to play it safe. Short-term U.S. Treasuries offered yields above 5%. And what that was, it's a rare chance to earn solid returns without locking up capital or even having to chase risk. So with the Fed starting to drive short-term yields down, what it starts to do is become obvious that investors are going to be forced into risk assets to chase returns. And this is exactly what the stock market knows. That's why it rallied today. But the economic damage here is going to be huge. As interest income goes down, what's going to happen to the spending of millions of retirees? It's going to drop right alongside it. And what that's going to do, it's going to amplify the liquidity problems, because less money sloshing around the system means the drain does not get plugged. And even worse, if savers start chasing risk assets, and if the Fed keeps cutting, they're going to have to. What it means is there's going to be less cash in the banking system at a time when banks are desperate and scrambling to get it. Now, next week's payroll report, it comes on Tuesday, and it's going to be critical because we've been waiting a long time for this due to the government shutdown. And I want you to understand why this matters, because without jobs, you don't have an income. Without income, well, you can't pay your bills. And what that means is delinquencies that are already starting to rise. And what are we seeing them? Across the automobile space, credit cards, even home loans are starting to hit delinquency numbers that we haven't seen in a while. And what that means is, next thing you know, this whole liquidity problem spirals out of control. And at that point, no matter rate cuts, no number of reserve management purchases can stop what's going to happen. Now, in terms of the non-farm pay report, I believe it's going to show further weakness. Here's the evidence. Let's take a look at this chart of the non-farm pay report shown in change of thousands of persons in blue against average hourly earnings of production and non-supervisory employees in red. And you can clearly see where wages go, jobs follow. Because based on layoff announcements and the deceleration of wage growth, it's highly likely payrolls are going to turn negative next year. And of course, what does that mean for the Fed? One rate cut in 2026? Not going to happen. They're going to be racing back to zero. Now, my biggest fear is if this rate cut doesn't work and these reserve management purchases don't stem the liquidity drain, and again, I don't think they're going to, but I think it's going to work enough to get us through the end of the year. But after that, I think we're staring down the barrel of a full-blown crisis, because what you're witnessing in real time is money leaving the system. Debts are being paid down. You're seeing delinquencies rise and defaults follow. And what happens? Money gets destroyed. And it's all happening at a rate that money isn't being created fast enough to fill the hole. And when that happens, well, history says we head right into a recession, or worse in this case, potentially another financial crisis. But that, my friends, is where the real wealth is made. So what's the path from this hawkish cut and liquidity scramble? Well, let's do some forward looking here, because I think this buys the Fed time before the year end. I don't think we have really any more issues. But Tuesday's non-farm pay report, it's critical. Now, if it's weak, expect some dovish pivots from the Fed. They're going to come out and say, well, if this continues weak, and we're going to cut. But the market, well, look for stocks to surge, because what they're going to sense of a weak pay report is more rate cuts. And it's going to be bullish, because what that means is savers are going to see their interest income drop and eventually be forced to chase risk assets for a return. Now, to trade this on the long side, you want to watch the 10-day volume profile. This is your line in the sand. This is your key support level. This is where you want to put your stop loss levels at. And what do you want to trade? You want to trade the biggest things. We're talking the mega caps, the major indices. These things are likely to have the biggest moves higher. Rent this rally, but don't own it, because this rally is an opportunity to diversify out of some of those vulnerable consumer stocks, trim your retail exposure, discretionary holdings. Again, we've been talking about why you want to trim this around 20 to 30% of your portfolio and look to rotate in things like defensives, utilities, healthcare. These things hold up in a downturn. Remember, this rally, it's not going to last, particularly if the labor market falls apart. There's a reason why Jeffrey Gundlach, he's the bond king. He said boost cash to 20% of your portfolio. This rally, that's your opportunity, because you're going to need some dry powder. And instead of cash, you want to consider short-term treasuries here. Now, we've been talking about being long the dollar, but with the rate cut, what are we seeing? The dollar's dropping here. So what you want to do is wait till it comes back down and then look to add some dollars. You want to hedge your portfolio with gold or silver. They've surged in the past, and today, gold is up, offering validation that it is the safe haven you need. And when it comes to timing the swings, you got to look to proven strategies like our CTA Timer Pro that nailed that 11.69% return on silver in just under a week. And we've already got some other trades we put on the other day that are already headed higher. Now, let me show you just how easy it is to make money in these markets with our report. Now, let's take a quick look at that silver trade, because it had something very important. It had a 63% expected win rate. But let's talk about how we put these trades together. Well, each and every day we look at the machine position across the broad equity, bond, currency, and commodity markets. And what we're looking to do is position our subscribers ahead of a big wave of machine buying and get them out before the machines sell. Now, these machines, they trace based on threshold levels, and what we've done is we've gone through and we've optimized them and backtested them. That win rate, we know exactly which one of these thresholds have the biggest return potential, and that's money in your pocket. And that is the advantage of a fully optimized system, which is exactly what we have. And it's so easy to use. You're going to log in, you're going to scroll all the way down, click on the newest date, and you're going to get an update on your existing trades. You're going to get all the new trades with full risk control levels, and you're going to get all the trades report generated that day. It's so easy. You get the tradable signals, my opinion on the best trades, risk control levels, a full tracking of all open trades and returns, a weekly update, and here's the best part. We're so confident that this can put money in your pocket, we're giving you a free 30-day trial. All you got to do, grab those links in the description below and use a coupon code for your free 30-day trial. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.